What can cause a stock to skyrocket overnight? Let's delve into the fascinating world of stock market surges, using the story of GameStop as a vivid illustration. Imagine a stock, somewhat unremarkable, that suddenly becomes the center of Wall Street's attention. This phenomenon often starts with short selling. Here's the gist. Investors borrow shares they believe are overvalued, sell them, and plan to buy them back later at a lower price, profiting from the difference. However, this strategy can backfire dramatically. In cases like GameStop, a surge in buying pressure, often from retail investors, can lead to a sudden and sharp increase in stock prices. This scenario forces short sellers to buy back shares at higher prices to close their positions, further driving up the stock price in a process known as a short squeeze. This cascade effect can cause stock prices to multiply at an astonishing rate, leaving the market in awe and short sellers in dismay. To understand this better, we need to dive into the mechanics of short selling. Short selling sounds complex, but it's a fundamental concept in the stock market. Let's dive into what it really entails, and why it's such a critical strategy for some investors. The essence of short selling revolves around the speculation that a stock's price will decline. It begins when an investor borrows shares of a stock, usually from a brokerage, and sells them at the current market price. The catch here is that the investor doesn't actually own these shares, they are borrowed. The goal is to later buy back the same number of shares at a lower price, return them to the lender, and pocket the difference as profit. Imagine, for example, an investor who borrows shares when they are worth $100 each. If the price drops to $70, the investor can then buy back the shares at this reduced price, return them, and make a tidy sum. However, if the price climbs to $150 instead, the scenario flips. The investor must buy back at a higher price, incurring a significant loss. This brings us to the risks of short selling. Unlike traditional investing, where losses are limited to the initial investment, the potential losses in short selling are theoretically infinite. A stock's price can rise much higher than its current price, escalating the cost of buying back shares and closing the short position. This risk is exacerbated during periods of market volatility or unexpected company success. Moreover, short sellers must also contend with various costs, such as interest on the borrowed shares, and additional fees which can erode profits or amplify losses. The need for careful risk management is paramount in short selling, requiring not just market savvy but nerves of steel. So with these risks, why do investors short sell? The potential for high rewards. When executed correctly, short selling can yield substantial profits, especially in a declining market. It also provides a way for investors to hedge against potential downturns in their other investments, making it a strategic, albeit high-stakes, component of broader investment approaches. Let's rewind to 2021, when GameStop became a battleground for retail and institutional investors. This was not just any stock market story, it was a David versus Goliath saga that captured the world's attention. In August of 2020, GameStop stock, abbreviated as GME, was modestly priced around $4. By the end of that year, the price had crept up to just under $20, thanks to strategic investments by notable figures. Yet the real drama unfolded in January 2021. On January 13th, GME shares nearly doubled to almost $40, with trading volumes hitting unprecedented levels. This surge was just the beginning. By January 22nd, the stock leaped over $70. The very next day, it soared to nearly $160. But the peak of this frenzy came on January 27th, when shares doubled yet again, trading at around $380 before reaching an all-time high of $483 on January 28th. What fueled this astronomical rise? A classic short squeeze. Leading up to 2021, several hedge funds had taken large short positions in GameStop, betting the stock would fall. This involves borrowing shares to sell them at the current price, with the aim to buy them back cheaper in the future, pocketing the difference. However, a band of retail investors, rallying through social media platforms like Reddit, recognized these shorts. They began buying up GameStop shares en masse, driving up the price. As the stock rose, short sellers were forced to buy back shares at much higher prices to cover their positions, further pushing the price upward in a vicious cycle. This phenomenon was not just about financial gains. When figures like Michael Burry revealed significant profits from early investments in GameStop, and icons like Elon Musk tweeted about the stock, the movement gained even more traction. Two funds, Citron Research and Melvin Capital, faced substantial losses due to their short positions. This highlighted the risks involved in short selling and underscored the power of collective retail investor action. This event didn't just shake the market, it changed how many perceive investing. Social media has shifted from a networking tool to a powerful market mover. The GameStop Saga of 2021 is a prime example of how platforms like Reddit and Twitter can dramatically influence financial markets. Let's dive into the mechanics of this phenomenon. Central to the GameStop frenzy was the subreddit r/Wall Street Bets. This online community became a rallying point for individual investors who collectively decided to challenge the market norms. These investors used the platform to encourage each other to buy and hold GameStop stock, which was heavily shorted by institutional investors. The goal? To trigger a short squeeze, pushing the stock prices to astronomical heights. Amidst this whirlwind was Keith Gill, better known as Roaring Kitty. His enthusiastic and detailed posts on Reddit and engaging videos on YouTube painted a bullish picture for GameStop. His influence was profound, illustrating how a single voice on social media can amplify market movements when it resonates with the sentiments of a large group of individual traders. Moreover, tweets from high-profile individuals like Elon Musk, who simply tweeted "GameStonk," added fuel to the fire. This single-word tweet referencing GameStop was retweeted and liked thousands of times, further influencing the stock's surge. As the stock price soared, it wasn't just about financial gain. It became a narrative battle between David and Goliath, between retail traders and large institutional investors. The power of collective retail trading was clearly showcased in this saga. Fast forward to 2024, and it seems history might be repeating itself with GameStop. On a seemingly ordinary Monday in May, GameStop stock took a dramatic leap, once again stirring the pot in the financial markets. This surge, reminiscent of the frenzy in 2021, inflicted nearly $1 billion in losses on short sellers, according to data from S3 Partners. But what's behind this sudden spike? The trigger seems to be none other than Roaring Kitty, a familiar name from the previous rally. Keith Gill, the man behind the moniker, posted for the first time since 2021 on the social platform X. His post showed a gamer leaning forward intently, a pose indicating serious gameplay, sparking widespread speculation and a rush of retail traders to buy into GameStop once again. This buying frenzy, driven by both nostalgia and the thrill of potential gains, forced many short sellers to cover their positions, propelling the stock even higher. Observers are now watching to see if more short sellers will jump in, betting that GameStop's price is peaking. Comparing this to 2021, the elements are strikingly similar. A charismatic internet personality, a rallying social media post, and a massive short squeeze. However, the context of 2024 may differ, with investors now more aware of the volatility and risks associated with such movements. Could this be another short squeeze, or is there something more? The answer might hinge on how well the market has learned its lessons from the past, and whether GameStop can sustain its value beyond the hype. As the stock climbs and dips, one thing remains clear: the GameStop saga continues to be a captivating chapter in the story of modern finance. Investing in volatile stocks like GameStop requires a nuanced strategy. When markets swing wildly, the allure of quick profits can be tempting. But it's crucial to anchor any investment decision in solid risk management principles. Let's dive into how you can navigate these choppy waters with confidence. Firstly, understanding the nature of the stock and the market conditions that lead to its volatility is essential. For stocks like GameStop, these conditions often include external factors such as market sentiment, media influence, and sometimes unusual trading activities like short squeezes. A well-informed investor is a prepared investor. Therefore, thorough research is not just recommended, it's a necessity. Now let's talk about risk management. It's the cornerstone of any investment strategy, especially in volatile markets. One effective method is the use of stop-loss orders. These orders can help protect your investment by automatically selling a stock at a preset price, thus limiting potential losses. However, be mindful that in extremely volatile markets, stop-loss orders may lead to execution at lower prices due to gaps in trading prices. Diversification is another key strategy. It's the age-old wisdom of not putting all your eggs in one basket. By spreading your investments across various sectors and asset classes, you can mitigate the risks associated with any single investment. In the context of volatile stocks, this means that any losses can be buffered by gains in other areas of your portfolio. Moreover, Consider the time horizon of your investment. Volatile markets are not typically suited for those with a short-term view unless day trading is your specific area of expertise. Long-term investors might see volatility as a bump in the road, part of the natural ebb and flow of the market, which might smooth out over time. Lastly, resist the urge to follow the hype. It's easy to get caught up in the frenzy of a soaring stock, driven by fear of missing out. However, investing based on hype rather than solid analysis is akin to gambling. Make decisions based on data, trends, and personal financial goals. Each investor needs a tailored approach, especially in unpredictable markets.